Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the election and where mortgage rates are going in a Trump presidency. We have a lot to discuss, but first I want to say thank you to our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast on a very volatile, crazy post-election day.
You know what's interesting right now? The 10-year yield this is Wednesday morning. It's around 10:25 a.m. It's like literally right at 440 key level. Last night, and I'm a bond market guy. I care less about politics, so I just work off of the data. I think as an analyst, that's the best way to do it. But when the 10-year yield hit 441 last night, I went to Instagram, created a reel, and said, Trump's winning, because that's what the bond market was doing. So when I talk a lot about my economic stuff, it's really off the 10-year yield, economic expectations. Politics plays a little role into it, but it's really economics is demographics and productivity. But of course, the 10-year yield went up a lot higher last night. It's been pretty wild today. The stock market's up. So what I'm going to do today is try to explain why people should not go into the 8% plus mortgage rates. This is it. Housing is finished. There's going to be tariffs, inflation, deficit spending. And I'm going to explain it line by line, which I don't really do this a lot because I'm not a big political economic theory guy, but I just see a lot of confusion out there. So today we're going to focus on the realities of what can happen with mortgage rates during the next 4 years and what can't happen.
I think that's really good because we know that, you've gotten a ton of messages and we know our traffic on our story talking about where mortgage rates are headed today is just going viral because people want to know. And, it's something that we talked about on this podcast yesterday on election day before we knew what the results would be. I asked you, what is it that people are afraid of? On each candidate, what could happen? And so you went into why people might be afraid of if there was a Trump win, what happened last time. So I think it's really important to go set the stage for is this a momentary thing? Should we, how long is higher rates going to stick around? Or if they're already going down? So Logan, lay it out. What should people be thinking about?
So first of all, until the 10-year yield closes above 4.40% and has followed through bond selling, the technical levels, the downtrend is still in there at 5%. I don't care what happens outside of that. All bond people that do this know what I'm talking about.
Well, wait. But relate that to mortgage rates just really quick.
If the 10-year yield broke above 4.40, closed, and then we saw follow through bond selling, the 10-year yield has the potential to get back to 5%, which will be near, I don't think it gets to 8%, but it would be near 8%.
Mortgage
so
rates.
I'm just a technical guy. All of you we have thousands and thousands of people now on Instagram stories, and we draw these lines for a reason. So for this week, because we still have the Fed meeting in a few days left, that is key on the short term. Now, I'm going to talk about the economics of Trump, because I did this before in 2016. In fact, when we wrote that article today about the realities of, where can mortgage rates go, I went back to my 2016 manufacturing article, back. Sarah, I had a lot more dark hair back then.
You did. You were not so salt and pepper.
I was like, who is that young kid? Oh my. In any case, the discussion has been, a lot of conservatives on Wall Street said that you need to short the 10-year yield because mortgage rates are going to go up, bond yields are going to go up because President Trump will be bad for deficits and his tariffs will be inflationary and the Fed will have to be less dovish during the next 4 years. So let's take every single one of those into account. Number one, when President Trump won in 2016, he did not go into the trade war tap dance. He waited until he got his corporate tax cuts in, and then he selectively went at it with China and, a few other countries. And I call it the trade war tap dance because we really didn't get into a full-on trade war. So I encourage everyone, You could go back to the CPI and PCE inflation back in 2018 and 19 when it was going on. It didn't take off. You have a one-time hit on pricing, and this is what the Federal Reserve has even talked about. They wrote a paper and said, okay, how will we handle a trade war? Well, if we raise rates to fight that, inflation, it'll be recessionary. Anything recessionary, bond yields go down, rates go down. So I don't believe the president is going to go into this full on 20% on everything, 100% on Mexico. No, a lot of it is talk. So if it does become a trade war tap dance, the one concern I would have is the same thing that happened in 2018 and 19. Business investment, even with the corporate tax cuts being given, basically went nowhere. If you look at the jobs data back then, there was a lot of negative revisions to that as well. I believe the Trump presidency and the people there realized what happened back then. That's not the avenue to go into right now. So until we actually see tariffs being placed, not talked about, in place, and then we're going to get retaliatory tariffs back on us, and then it becomes a trade war. Until that happens, don't speculate on the worst case scenario damages of that, because I think there was some lessons learned about how that operated. Of course, he's probably going to go it head to head with China a few times, but I'd be very cautious on the higher inflation because of tariffs. What happened last time, I urge everyone, go look at the inflation data back then. It didn't take off, right? So let's put that aside until it actually happens and see what the scale is. Because once you do something to a country does it right back, and it becomes a trade war. Number two, and we've already talked about this, the Federal Reserve, if they stick to their original premise about going after or handling tariffs, they're not going to be hiking rates in there. You could make a case that they might not be as dovish as they would have been, but that is something that is, again, a speculative theory out there. So in that context, let's not put the Fed has to hike rates to fight tariffs and inflation. Again, another speculative discussion that's happening. So that's number two. Number three, the deficits going up because there's going to be lots of tax cuts given. We had deficits. We had $1 trillion deficit back then. Mortgage rates stayed in that channel. The 10-year yield still stayed in that channel. I'd be very suspicious of using that as mortgage rates are going to go to 8 or 9% in that regards. And then we go back to the construct of economic cycles. President Trump wants the dollar to go lower because when the dollar goes lower, he can export more stuff around the world. Because the dollar's too strong, we're not a heavy exporting nation. President Trump wants lower rates. Why? Because his plan to fight the deficit is going to be interest payments coming down. Okay. He can't do anything to Powell right away. He could talk him down, but that's not going to move anything. If he puts someone in charge that he wants, that's the idea of attacking the deficit, is bringing the Fed funds rate down and interest. It's not, majority of our spending in this country is mandatory spending, Social Security and Medicare. No one's touching those things in any big fashion. So he would like to have lower rates, and he would like to have the dollar weaker. Today, the dollar is up, the 10-year yield is up. When I think about how housing is, we have data this year. Purchase application data came out again today, down 5% a week to week, down or up 2% year over year. 6.75 to 7.5% mortgage rates is very difficult for the builders to operate. Housing starts are at recession lows. Housing permits are at recession lows. Not the bottom of COVID, but basically in the early parts. There's a lot of people that said we are going to address affordable housing. There's two ways you address affordable housing. Number one, mortgage rates go lower. Makes the payment less. Number two, you build homes. Monetary policy is too tight right now to build homes. We had this discussion yesterday. So lower rates, lower dollar is something I believe he is going to want to push and fight for because it fits his agenda a little bit better. So if it does, let's say I'm wrong and rates get elevated higher and the Fed is not very dovish, it'll impact the economic data. And for those of you that read the article, you can see why I'm very keen on residential construction workers. That's one of the missing links, that when that falls, we're heading into a recession. Usually manufacturing goes with it, and then the 10-year yield goes down. So let's be a little bit mindful on the 8% plus deficits are going to blow out. There's a lot of Wall Street people that talk their book, and then after a few days, things calm down. We go back to the economic cycle. So I'm urging people, wait a week, and then we'll take it kind of one day at a time.
So let's talk about Jerome Powell, right? So Fed Chair Powell, he was nominated by Trump back in 2017, renominated by Biden in 2021. But Trump said a couple months ago on the trail that he felt like the president should have more control of the Federal Reserve and mortgage rates, specifically like very direct control. So we know that Powell isn't going to do that. So if he doesn't do that, I mean, I think he doesn't do that. He didn't do that. He didn't allow that sort of direct control when Trump was president before. Does that mean, do you anticipate Trump picking somebody else?
Yes.
You do. Okay.
More in line. Now, at first they wanted Judy Shelton to be there. And Judy Shelton is a gold bug. But she was all about lowering rates back then to help Trump's economic plan. You have to remember, people's ideological takes, whenever somebody else is in power, they go full on it. When they're in power, a lot of things change. So whoever Trump's going to nominate next, it'll be interesting who it is, because I could foresee President Trump saying we need rates lower, we need QE, because he does need the dollar to go lower, and he does need mortgage rates to come down, because the last thing he needs right now is the residential construction workers go into recession. Right. Then all of a sudden they say, well, look, you blew up the deficit, tariffs, all. He doesn't want to deal with that. So it is more in line to his benefit and to the people around him that doesn't occur. Now, does he have any control or say on it? No, but he does know what can cause problems if that's the case. This is why I'm not a big believer on this big inflation push we're going to get on tariffs. It'll be how I call it, a trade war tap dance. It'll be calculated in there. I know he talked about this, we're going to go straight into 20% tariffs. This is just how he operates, right? It's a little bit different than other presidents. So just be a little bit mindful of that. If I'm wrong and he goes into a full trade war and it does create inflation, then that's very problematic, okay? Because the Fed's going to be a little bit more mindful about maybe cutting rates, and he does need rates to go lower to try to attack affordable housing, which I'm very suspect of anyway. So just be careful of what somebody says running for president and then what actually happens. Because back in 2016, he waited 2 years. He got his corporate tax cuts in. Then he went into the trade war tap dance. And I don't believe he got what he wanted. What happened toward the second half of 2019, the economic data started to get better because there were talks about, oh, hey, listen, we're going to take care of this trade war tap dance. And then business investment started to kick up, and manufacturing data kept up. Retail sales were growing. Housing demand came back second half of 2020. And then the first 2 months of 2020 were actually good economic data. God, nobody remembers this, but I do. And in that case, it can be solved. So I think they learned a little bit from that experience last time on what to do, what not to do. But at this point, it's probably not the best environment to go into a full-blown trade war.
I think one of the questions I have about this Trump administration that's coming up is he is a guy who is seemingly very motivated by who is loyal to him and who is not. And you had a whole bunch of people from the last administration that he ran come out against him in this election. So it's going to be interesting to me to see who's left that he feels like is loyal enough to put into these different positions. So, you got
He's got tons of people he could put in. Yeah, there's no small count of people that he couldn't put into places. I do believe former hedge fund Paulson will probably be the Treasury Secretary, and for whatever it's worth, he kind of like shot down this whole trade war, tariff, inflationary thing. He said he doesn't believe that it'll be going into the full blown effects of that. And there was a lot of other people that were Wall Street backers that kind of said the same thing. What he says and does will be two different things. We're kind of in that environment where job growth is slowing down, and any kind of shock into the system. How do recessions happen? A lot of times you get a shock into the system that you don't want to risk that at this point, right? You kind of want to lay the groundworks before you want to start whatever you want to start with China at that point. So early on, it shouldn't be the case. And again, we'll know more information as time progresses on. We're right after the election, and we have a Fed meeting. So we just keep in line with the economic data that we've had that we have to work with. That matters. I mean, I say this with all honesty. If the economic data wasn't beating estimates in the last 2 months, the 10-year yield wouldn't even be here, right? If we were growing at sub 1%, wage growth was at 3%, job numbers were coming in at 70,000. If it was something to that nature, retail sales missed estimates 3 months, something like that, we wouldn't even have this discussion because the economic data still runs all of this.
I think it's again, you and I have talked about this, of the double-edged sword of being in housing, in that, of course, we never would wish for there to be a downturn. But when the economy is booming, that has, in this particular environment, has a really negative effect on rates, which has a negative effect on housing, which is why housing has been in a recession since 2022, correct?
June 16th, 2022, the existing home sales has been in a recession. Housing starts and permits are in a recession. Residential construction workers have not lost their jobs. Yes, that's the big tamale. So I think a lot of people always say that housing's in a recession if home prices fall. That it's a silly statement. The majority of the years post 1942, home prices are up. We've had plenty of housing recessions post World War II without prices falling. The irony, Sarah, is that I think the second article I wrote for HousingWire was talking about the economy is picking up because the trade war tap dance is going away. And if that happens, the 10-year yield of mortgage rates could go up and that can slow housing. That was in 2020, early
Right.
2020. And then COVID happened. And of course, anybody who followed me back then, I was like, if the 10-year yield doesn't break over 1.94%, nobody go into the super growth theory. That's our key line. So that was my key line back then. But that was actually occurring. I know this because I literally wrote an article right on COVID and said, here is what the pre-COVID data looked like. And it was actually getting better, right? ISM service was 57%. Retail sales were up 4% year over year. Manufacturing data was coming back. Housing broke out before COVID hit us, starts, existing home sales. So the data had been getting better. But in this context, we just don't have that right backdrop to go into this right now. So I think once we get people in positions, and it's going to take some time, a few months to get the whole team and everything in there, and then we could start formulating what the game plan is, what is this, and how does that affect. But as of right now, let's stick to the economic data. If the economic data gets weaker, 10-year yield goes down. If it gets stronger, 10-year yield up like it is. And we're working off of a channel. We did not break over 5% last year. Right now, that key level is 440 right now. But also one thing today, you could really see the benefits of better spreads. Some daily pricing wasn't as high as some people thought it would be. But if I took the worst levels of the spreads last year, we're easily over 7.60% in mortgage rates today. So the spreads, again, being better on the way down in rates really shows, but even on the way up in rates really shows how bad it could have been if the spreads did not improve.
Okay, so we have 2 months before Inauguration Day. In that time, President Biden could do some things, Jerome Powell could do some things. If you're a loan officer out there, if you're in real estate out there, what do you plan on for the next 2 months? What do you think is going to happen?
Well, again, the economic data will run the 10-year yield, and the housing market runs off of the 10-year yield and mortgage rates. So if you get softer economic data, for Biden can't do anything, and Jerome Powell is going to cut rates. His language could be a little bit interesting in the meeting by the time this podcast comes out, or we'll get some of that. You want to see if they ever kind of mention. I doubt he will mention anything about what to do in the future. Some people are already speculating that they won't cut rates in December because of this. They operate in a different way. They're just going to get down toward neutral and then take it from there. And if anything pops up where they find it to be, okay, we can't be as dovish anymore because inflation is popping up, that's a whole different conversation that we have to get to that point first before we go there. And again, follow the economic data weekly. If it gets weaker, trust me, the 10-year yield is going to go down. If it gets stronger, the 10-year yield can stay elevated.
Okay, well, so that's a lot that's going on. The fact that this is completely overshadowed Fed Week is kind of amazing. So tell me what you expect with Fed Week.
Just a quarter cut language. It'll be interesting to see what they say about the last jobs report, if they just kind of go against it and say that was just a one-off. I argue that the manufacturing data has been getting softer, even if I take the Boeing data out. Now, of course, the restrike and the coming back will maybe boost some of the numbers. But again, to them, they've always focused on jobless claims. And jobless claims data has been heading lower recently, and it's at 216,000. So in their minds, they still see the labor market is intact. It's getting weaker. It's getting softer. For 13 months, the internals of the job openings data, which they run off, is why they cut half a percent. So we'll see. Sarah, it's going to be more interesting in the next 4 years, because we're going to get a little bit more action around the Federal Reserve than what we probably would have had in the last 4 years. And we'll see how the economic data responds to any kind of new policy. But for right now, everyone just needs to relax, calm down. This is me like back in 2016, 2017. Everybody just calm down. I understand politics is a very emotional thing. I don't care. Some people say you're a sociopath. I am. I'm just looking at the data, and I'm an analyst. I don't care about all the other stuff. But you need policy to change and action to happen before I could ever say, well, this is really bad or that's bad. All I know is that what we've seen this year is when mortgage rates get between 6.75 and 7.5%, housing demand trends negative. The builders are already at recession levels. That is not a positive. I am pretty sure they're thinking about that at this stage. That's the last thing you want, is all of a sudden you're losing construction workers and demand goes lower and housing starts to go lower, because that everyone wants to see more building happening. And I've always said you need monetary policy and government policies to work together. If you really wanted to do that, you have to join them in together to have that become a really big plus for the nation.
I do think so. Yesterday we were talking about, how can we get more housing? You're like, no, the system's not set up that way. But, in a Harris administration, it was one of her platforms. We did not see the same thing. We have not heard any about building from Donald Trump. So that feels like it's going to be dead in the water.
Well, there's a lot of Trump people that talked about affordable housing is going to be a goal of theirs. There's no plan for it. But again, it's very simple. Mortgage rates go lower, housing is more affordable because the payment is lower. Or you build a lot of new homes, okay? Policy is too restrictive to build homes right now. That's why housing starts a recession. Do not make it any more complicated than that. That's just how economics is, right? If you get monetary policy and federal policy and state and local levels, everything working together, that is something. But it is not a shock to me that housing permits are at recession lows, housing starts at recession lows, mortgage rates have gone up. Most likely it's going to eventually impact the builder's confidence. And then that means at this stage of where we are right now, it's not like before. We're already at recession levels. Those units that are being built and finished right now, once those jobs are done, the work is not there anymore. That's how cycles have worked post-World War II. This is why I always like to show that residential construction worker chart, why that is so key to economic cycle expansions or recessions.
Logan, thank you for being on 3 times this week because we have so much going on. I so appreciate it. I know our listeners do too, because these are uncertain times when we have such a close election and there wasn't really a good sense for who was going to win. Even yesterday, we're like, we're not sure. And then, you did call it last night. I think it was hours later than that when it got officially called. So I appreciate you being on and walking through all of the things that people are worried about. We'll have you on again soon on our regular schedule next week.
Pleasure to be here, Sarah. I hope you win your fantasy football league game.
Listen,
and get out of last place.
I've dug such a hole on fantasy. I don't even know how I get out. Okay. Well, thank you so much, Logan.